Do Canadian investors in U.S. real estate pay U.S. estate taxes? U.S. estate taxes is a major concern for many Canadian investors in U.S. real estate. The U.S. estate tax is very punishing because of its extremely high rate of tax. In fact, it can be as high as 40% of the value of your U.S. assets in excess of $1 million. What's worse is that U.S. estate taxes is charged on the fair market value of your U.S. assets upon your death. Imagine if you had to pay $400,000 in U.S. estate taxes on $1 million of assets. Fortunately, most Canadians won't have to worry about U.S. estate taxes. This is because U.S. estate taxes are triggered if your worldwide assets are more than $5,340,000 as of 2014. There is a practical solution to the U.S. estate tax problem called the two-tier tax structure. The first tier is represented by a Canadian limited partnership. You and your family members are limited partners in this Canadian partnership. The second tier, below the line, is represented by a U.S. limited partnership. In this setup, the Canadian partnership owns 99% of the partnership units in the U.S. LP. The remaining 1% is owned by a U.S. C corporation, which acts as a general partner. When one of the partners of the Canadian partnership passes away, U.S. estate tax is not triggered. This is because partnership units owned in a Canadian partnership are not considered a U.S. asset for U.S. estate tax purposes. Remember, only U.S. assets are subject to U.S. estate taxes. The other advantages of this structure is that it provides for limited liability protection to the investors and prevents double taxation by the U.S. and Canadian tax authorities. So here's the tip. If your portfolio of investments is approaching $5 million or more, you should set up a two-tier partnership in order to avoid U.S. estate taxes. If you like this tip and want to know more, drop us a comment below or visit maddenca.com. And as always, don't forget to like and subscribe so we can bring you great tax tips every week.